There is a ghost in the machine of Wall Street. It's a phantom that whispers promises of certainty in a world that is fundamentally, inescapably uncertain. It wears the tailored suit of a senior analyst, speaks in the confident language of quarterly reports, and materializes in the crisp, colorful charts of a 5-year projection. It hands you a beautifully formatted spreadsheet, a document humming with the false authority of decimal points and growth assumptions calculated to the 100th%. This spreadsheet tells you a story, a comforting bedtime story for investors. It says that the earnings of this particular company will grow by 25.3% next year, 22.7% the year after, and a steady 18% for the decade to follow. It concludes with a flourish, a final definitive number, a price target of $173.50. And because the human mind abhors a vacuum, because we are biologically wired to seek patterns and crave predictability, we embrace this ghost. We mistake its fiction for a fact. We treat its prophecy as a promise. And in doing so, we commit one of the most fundamental and costly errors in the entire field of finance. Warren Buffett, the man who has compounded capital at a rate that defies financial gravity for over 60 years, has built his empire on a single foundational truth that stands in direct opposition to this entire charade. He understands that the future is not knowable, not in that kind of granular detail. He knows that the ghost in the machine is just that, a ghost. And basing your financial decisions, your life savings, your family's future, on the whispers of a phantom is an act of profound recklessness. The financial transformation we are about to embark on is the journey from being a believer in these financial forecasts to becoming a skeptic of them. It is about learning to discard the seductive but spurious precision of a spreadsheet and instead to focus on the durable, qualitative, and understandable realities of a business. We will learn to analyze a company not by guessing its earnings in the year 2034, but by judging the strength of its competitive fortress today. We will learn to evaluate its leadership not by their polished presentations, but by their long-term track record of rational capital allocation. This is the shift from gambling on a number to investing in a business. It is the core principle that separates the consistent winners from the 99% of market participants who are perpetually tossed about by the chaotic winds of sentiment and surprise. This is the final promise, not a promise of a specific price target, but the promise of a mental model that can protect you from the single greatest source of error in investing, and in doing so, unlock the door to true sustainable portfolio growth and long-term financial freedom. Our journey begins by dissecting this grand illusion, by understanding precisely why the detailed financial forecast is one of the most dangerous instruments ever invented. We will explore the psychological traps it sets for our minds, the faulty logic upon which it is built, and the catastrophic financial consequences of falling for its siren song. This first pillar of our new understanding is built on a simple but powerful idea: the deep and perilous danger of the illusion of precision. To truly grasp its power, we must travel back in time, not to a story of one of Buffett's legendary successes, but to one of his most painful and instructive failures. A failure that cost Berkshire Hathaway shareholders billions of dollars, and was, in Buffett's own words, his worst deal ever. It is the story of a shoe company, a seemingly indestructible moat, and a future that refused to comply with the forecast. The year was 1993. Warren Buffett was at the apex of his powers. Berkshire Hathaway was a juggernaut, and its chairman was a living legend, revered for his uncanny ability to identify wonderful businesses at fair prices. One such business, he believed, was the Dexter Shoe Company. Based in Maine, Dexter was a classic American success story. It produced sturdy, well-made shoes entirely in the United States, and it had cultivated a brand synonymous with quality and durability. For decades, the business had been a model of consistency. It gushed cash, earned good returns on its capital, and seemed to possess what Buffett prized above all else: a durable competitive advantage. The brand was strong, the operations were efficient, and its long history of profitability seemed to suggest a highly predictable future. It looked like a business you could model on a spreadsheet with a high degree of confidence. Buffett was so confident, in fact, that he decided to do something he rarely did. He bought the entire company not with cash but with Berkshire Hathaway stock. The price was 203 shares of Berkshire A, which at the time were worth approximately $433 million. To put that in perspective, those same shares today would be worth over $15 billion. This was not a small bet. It was a massive vote of confidence, an acquisition funded with the crown jewels of his own empire. The implicit forecast was clear. Dexter Shoe would continue to generate the strong, reliable profits it always had, and those profits would now flow into Berkshire's coffers, justifying the use of its precious, rapidly compounding stock. The business had a moat, he thought. It had a history. The future seemed, if not guaranteed, then at least highly probable. But the ghost in the machine had other plans. What the historical data and the confident projections failed to account for was a seismic shift in the global economy. Low-cost foreign manufacturers began to flood the American market with shoes that, while perhaps not of the same quality as Dexter's, were dramatically cheaper. The competitive landscape didn't just change, it was obliterated. Dexter's moat, which looked so wide and deep when viewed through the rearview mirror of past financial statements, turned out to be a shallow ditch. The company's pricing power vanished, its profits withered. The once mighty American manufacturing operation became an anchor, a high-cost relic in a new, globalized world. The business that was supposed to be a perpetual cash machine began to bleed money. Within a decade, the assets of Dexter Shoe were essentially worthless. The $433 million of Berkshire stock was gone, vaporized. But the real cost was the opportunity cost. The shares Buffett had traded for a dying shoe business went on to become fantastically valuable. He hadn't just made a $433 million mistake. He had made a multi-billion-dollar mistake. In his 2007 letter to shareholders, Buffett wrote with his trademark candor, "To date, Dexter is the worst deal that I've made, but I'll make more mistakes in the future. You can bet on that." He went on to explain the crucial lesson. What I had assessed as a durable competitive advantage vanished within a few years. The forecast, the one implied by decades of steady performance, was not just wrong. It was catastrophically, portfolio-cripplingly wrong. The illusion of a predictable future, based on a wonderful past, had seduced the greatest investor in modern history. It's a story that should be etched into the mind of every retail investor, every professional engaged in stock analysis, and anyone performing due diligence on a business. It is the ultimate proof that no matter how smart you are, no matter how great a company's history has been, the future remains a wild and unpredictable territory. A detailed map of that territory, offered by Wall Street or a CEO, is nothing more than a work of fiction. The Dexter Shoe fiasco is a dramatic illustration of a powerful psychological principle at play. Why are we so drawn to these precise forecasts, even when we intellectually know the future is uncertain? The answer lies in two deep-seated cognitive biases, the certainty bias and the precision bias. Our brains did not evolve in the complex, chaotic world of global financial markets. They evolved on the savannah, where survival depended on making quick, decisive judgments based on limited information. Our minds are pattern recognition machines that crave closure and despise ambiguity. A vague truth such as, "This is a good company that will probably do well over the long term," is deeply unsatisfying to our brain's operating system. It leaves too many open loops, it feels incomplete. Now, consider the alternative presented by a Wall Street analyst. A 50-page report, filled with charts, graphs, and a discounted cash flow model that projects earnings per share out to the year 2035, with a final intrinsic value calculated to 2 decimal places. This document doesn't offer a vague probability, it offers the illusion of scientific certainty. The precision bias kicks in. We unconsciously equate precision with accuracy. We think that because a number is highly specific, say, a price target of $173.50, it must be the result of a rigorous and reliable process. It feels more credible than a simple statement like, the stock is probably worth somewhere between $150 and $200. The specificity acts as a cognitive anesthetic, numbing our natural skepticism. We are so impressed by the intricate details of the calculation that we fail to question the gigantic, unprovable assumptions upon which the entire edifice is built. The certainty bias is the other half of this mental trap. We want to believe that the experts know what they are doing. We want to believe that the future can be tamed and predicted. The financial forecasting industry is, in essence, a multi-billion-dollar enterprise dedicated to selling us this feeling of certainty. They are not selling a product. They are selling a psychological comfort blanket. When a CEO stands on a stage and confidently projects 15% annual growth for the next 5 years, they are alleviating the anxiety of the unknown for their investors. It's a powerful and seductive message. We latch onto it because the alternative, admitting that we are all operating in a fog of uncertainty, is deeply unsettling. This is why financial television is filled with confident pronouncements and price targets, and not with humble admissions of ignorance. Humility doesn't attract viewers or clients. Certainty, even if it's completely fabricated, sells. Buffett's approach is to consciously fight this urge. He embraces the uncertainty and forces himself to operate within its confines, which is a far more difficult but ultimately more profitable path. So how do we, as individual investors striving for better portfolio growth, translate this understanding into a practical tool? The applied mental model to combat the illusion of precision is one of Buffett's most famous concepts, the circle of competence. But we need to think about this model in a more rigorous way than it is usually presented. It's not just about investing in industries you understand. It's a disciplined process for distinguishing between what is reasonably forecastable and what is pure speculation. It is the ultimate due diligence checklist for reality testing a business. The first step in applying the circle of competence blueprint is to ask a fundamental question about any potential investment. Can I, with a reasonable degree of confidence, predict the unit sales, selling prices, and profit margins for this company's primary products or services 10 years from now? Let's take 2 examples. Consider the Coca-Cola Company. Can you guess, roughly, how many servings of Coke and other beverages they will sell globally in a decade? Probably. It will likely be a bit more than they sell today, as populations grow and they expand in developing markets. Can you guess the price? It will likely be a bit higher than it is today, due to inflation and their brand's pricing power. Can you guess the profit margins? They will probably be similar to their historically stable margins. The key variables are few, and they change slowly. Coca-Cola resides within a circle of competence for many investors, because its future is, in a broad sense, predictable. Now consider a company that makes cutting-edge semiconductors for artificial intelligence applications. Can you predict their unit sales in 10 years? Absolutely not. It depends on which technology wins, which competitors emerge, and the pace of innovation, which is blindingly fast. Can you predict the selling price? No. Today's premium chip could be a low-margin commodity in 5 years. Can you predict the profit margins? Impossible. They might be 60% or they might be 6%. The number of critical variables is immense, and their rate of change is explosive. This business, for most people, lies far outside a reasonable circle of competence. The blueprint, therefore, is not to become an expert on semiconductors. It is to recognize the inherent unpredictability of that industry and simply place it in the too hard pile. This isn't an admission of failure. It is an act of supreme intellectual discipline. It's the first line of defense in any sound investment strategy. The second step of the blueprint is to analyze the rate of change within the industry. The faster things change, the shorter the useful life of any forecast. Think about the newspaper industry in 1995 versus today, or the taxi industry before and after Uber. A business that is protected from rapid change, what Buffett calls a business with a durable moat, is inherently more predictable and thus a better candidate for investment. Before you even look at a spreadsheet, you must assess the stability of the competitive landscape. Is this a placid lake or a raging whitewater river? The financial models of Wall Street treat every business as if it operates on a placid lake, with smooth, predictable currents. Your job is to be the realist who sees the rapids ahead. This simple, qualitative assessment is infinitely more valuable than a 20-page financial model that ignores it. Now let us examine the opposite approach, the path trodden by the overwhelming majority of market participants. This is the path of analyst worship. The retail investor who follows this path treats the pronouncements of Wall Street analysts not as opinions, but as gospel. Their process begins not with the business, but with the stock. They hear about a hot stock on the news or in a forum. Their first move is to look up the analyst ratings. They see a chorus of strong buy recommendations. Their second move is to find the most bullish analyst report they can. They download the PDF, and their eyes glaze over with a sense of awe and sophistication. Here it is, the detailed discounted cash flow model, the sensitivity analysis, the tables of comparable companies. It looks like science. It feels like rigorous work has been done on their behalf. They fixate on the final number, the 12-month price target. To them, this isn't a guess. It's a destination. They feel a surge of confidence. They are no longer just a retail investor making a guess. They are aligning themselves with a powerful institution, a team of smart people in suits who have surely done the work. They are part of the herd, and it feels safe. This mindset leads them directly into the jaws of the market's most vicious traps. They buy technology companies with exciting stories but no profits, because the forecasts show massive earnings in the distant future. They buy cyclical companies at the top of the economic cycle, because the recent results have been fantastic, and analysts simply extrapolate that strength forward. They fall in love with the beautifully formatted spreadsheet, the narrative of unstoppable growth. They are seduced by the illusion of precision. And when reality inevitably deviates from the forecast, when a new competitor emerges, when a recession hits, when a new technology disrupts the industry, the entire foundation of their investment thesis crumbles. The price target is revealed to be a phantom, and the stock price collapses. They are left holding a bag of broken promises, wondering what went wrong. What went wrong is that they outsourced their thinking and placed their faith in a fiction, mistaking a detailed map for the actual territory. The most direct way to understand the complete futility of this approach is to see how it manifests financially, through the very tool the analysts use, the discounted cash flow or DCF model. The concept is simple. A business is worth the sum of all the cash it will generate in the future, discounted back to today's value. It sounds logical, but the ghost is in the details. A DCF model requires you to make dozens of assumptions, but two of them are so powerful, they control the entire output. The first is the growth rate of cash flows you assume for the next 5 or 10 years. The second, and far more powerful, is the quote, terminal value, which is a guess at what the business will be worth at the end of the forecast period, often calculated using a quote, perpetual growth rate assumption. Let's run a simplified example. Imagine a company that currently generates $100 million in free cash flow. An analyst builds a model. They assume with great confidence that this cash flow will grow at 10% per year for the next 10 years. Then, they assume it will grow at a rate of 3% into perpetuity after that. They run their complex calculations, apply a discount rate, and the model spits out an intrinsic value of, say, $2.5 billion. The stock is currently trading at $2 billion, so they issue a buy rating. It all looks very scientific. But what if the growth for the next decade is not 10%, but a slightly less rosy 8%? And what if the perpetual growth rate is a more conservative 2.5%? These are tiny, seemingly insignificant tweaks to long-term assumptions that no human can possibly know with any accuracy. Yet, when you plug these new numbers into the very same model, the calculated intrinsic value might plummet to $1.8 billion. Suddenly, the stock is no longer a buy, it's a sell. The entire conclusion of the analysis has been flipped on its head by a minuscule change in a guess about the distant future. This is the dirty secret of financial modeling. The output is not an objective truth, it is merely an exquisitely sensitive reflection of the analyst's initial biases and assumptions. The process is garbage in, gospel out. The precision of the final number is a complete and utter mirage, designed to conceal the wild speculation at its core. Understanding this single point, that the model is a machine for laundering opinion into the appearance of fact, is the first giant leap toward a more robust and reality-based investment strategy. It frees you from the tyranny of the price target and allows you to start focusing on what truly matters. This brings us to the second great pillar of our thesis, the fundamental error baked into almost every financial forecast, the fallacy of extrapolation. If the models themselves are exquisitely sensitive to inputs, the method for generating those inputs is often laughably simplistic. For the most part, analysts and corporate managers do one thing. They look at the recent past and draw a straight line into the future. If a company has been growing at 20% a year for the past 3 years, the default assumption is that it will continue to grow at or near 20% for the next 5 years. This linear thinking is easy, it's comforting, and it is almost always wrong. The real world is not linear. It is cyclical, chaotic, and governed by a powerful force that Wall Street forecasts conveniently ignore: mean reversion. To understand the destructive power of extrapolation, we must visit one of the darkest periods in modern market history, the crash of the Nifty 50 stocks in the early 1970s. The Nifty 50 was a group of about 50 large-cap blue-chip stocks on the New York Stock Exchange that were widely regarded as one-decision stocks. You buy them, and you never have to sell. The list included the titans of American industry, companies like IBM, Xerox, Polaroid, Coca-Cola, and Procter & Gamble. These were wonderful businesses, the dominant corporations of their era. They had grown earnings and dividends at a spectacular and consistent rate for decades. And on Wall Street, the narrative took hold that their greatness made them immune to the normal rules of valuation. Analysts and money managers fell victim to the fallacy of extrapolation on an epic scale. They took the superb growth rates of the 1950s and 1960s and projected them forward, not just for a few years, but seemingly forever. This created a feedback loop. As the stories of their inevitable perpetual growth became more compelling, investors were willing to pay higher and higher prices for their stocks. Price-to-earnings ratios, the classic valuation metric, were stretched to absurd levels. It was not uncommon to see these safe stocks trading at 50, 60, or even 80 times their annual earnings. The justification was always the same. Their growth is so certain and so rapid that they will quickly grow into the valuation. The forecast, a straight line pointing to the sky, made any price seem reasonable. It was the epitome of a market mania built on a faulty mental model. Then came the brutal reality check of the 1973-1974 stock market crash, triggered by the oil crisis and a deep recession. The inevitable growth of the Nifty 50 suddenly wasn't so inevitable. Earnings for many of these great companies faltered. But the real damage was to the narrative. The spell was broken. Investors who had been willing to pay 80 times earnings suddenly decided that 20 times earnings was more appropriate. It wasn't just the earnings that fell. The valuation multiples collapsed, and the result was carnage. Stocks that were considered the safest investments in the world plummeted. Xerox fell by nearly 71%. Polaroid, a darling of the era, crashed by a staggering 91%. Even a stalwart like Coca-Cola lost nearly half its value. Portfolios were decimated. An entire generation of investors learned a painful lesson. No company, no matter how great, is worth an infinite price. And a wonderful business bought at a terrible price based on an impossibly optimistic forecast results in a terrible investment. The straight line of extrapolation had led investors straight off a cliff. What psychological forces lead us to make such a basic error time and time again? The primary culprits are recency bias and the narrative fallacy. Recency bias is our brain's tendency to give disproportionate weight to recent events when making judgments about the future. If a stock has been on a tear for the last 2 years, our mind finds it much easier to imagine that trend continuing than to imagine it reversing. The recent past feels more real, more vivid, and therefore more predictive than the distant past. We forget the lessons of previous cycles, like the Nifty 50 crash, because the immediate experience of rising prices is so much more powerful. The narrative fallacy, a concept popularized by Nassim Taleb, is the second part of the trap. Our minds are not content with random data. We need to weave events into a coherent story to make sense of them. When a company experiences a period of high growth, we don't just see the numbers, we construct a story to explain it. This company is disrupting the old guard. Their visionary CEO is a genius. Their technology is the future. This narrative makes the past growth feel logical, and the future growth feel inevitable. It transforms a simple trend into a destiny. The story becomes so compelling that it blinds us to contradictory evidence. We fall in love with the narrative, and the financial forecast becomes simply the mathematical expression of that love story. This is why, during the dot-com bubble, investors could believe that a company with no revenue and no profits was worth billions. The narrative, "The internet changes everything," was so powerful it supplanted the need for traditional business analysis. The forecasts were just fiction written to justify the narrative. Buffett's approach is the polar opposite. He actively distrusts narratives. He looks for the boring, the predictable, the businesses that don't require a heroic story to justify their existence. He is a collector of facts, not a consumer of stories. To immunize ourselves from the lethal combination of recency bias and narrative-driven investing, we need a mental model that forces us to challenge the extrapolation. That model is a combination of two powerful techniques: inversion and the systematic search for forces of mean reversion. Inversion, a favorite tool of Buffett's partner Charlie Munger, means approaching a problem backward. Instead of asking, "How can this company continue to grow at 20% a year?" you invert the question. You ask, "What could stop this company from growing at 20% a year?" This simple flip in perspective changes everything. It shifts your brain from a mode of confirmation, where you are looking for evidence to support the popular narrative, to a mode of disconfirmation, where you are actively looking for risks and potential points of failure. The applied blueprint using inversion looks like this. First, list all the things that would need to go right for the rosy forecast to come true. The company must maintain its market share, profit margins must stay high, the overall economy must cooperate, no new disruptive technology can emerge, and key management must stay in place. Then, for each of these assumptions, you actively search for threats. You read about new competitors. You analyze if their high profit margins are attracting envy and competition. You study the industry for signs of technological disruption. You are no longer a cheerleader for the stock. You are a detective looking for the holes in the case. This process of pre-mortem analysis, imagining failure in advance, is one of the most effective ways to break the spell of an alluring narrative. The second part of the blueprint is to become a student of mean reversion. Mean reversion is the powerful tendency for things to return to their long-term average over time. High-flying stocks revert to more normal valuations. Exceptionally high profit margins get competed away. This is the financial equivalent of gravity. The blueprint is to create a checklist to spot where mean reversion is most likely to strike. Question 1. How do the company's current profit margins compare to its 10-year average and the average of its industry? If they are at all-time highs, you should be extremely skeptical that they can stay there. Gravity will eventually pull them down. Question 2. How does the company's current valuation, its P/E ratio, compare to its historical average? If you are paying 40 times earnings for a company that has historically traded at 20 times earnings, you are making a dangerous bet that this time is different. Question 3. Is the company's success attracting powerful and well-funded competitors? The greatest enemy of a successful business is the new capital it attracts. Success breeds competition, which is a powerful force for mean reversion. By systematically asking these questions, you are building a defense against the simplistic linear thinking that gets so many investors into trouble. Let's look at the antithesis, the path of the 99% who fall for the extrapolation trap. This is the investor who engages in chasing hot stocks. Their investment process is driven entirely by FOMO, the fear of missing out. They see a stock chart that has gone parabolic, rocketing up 200% or 300% in a year. They turn on their favorite financial news channel, and the pundits are breathless, talking about the company's paradigm-shifting technology and its total addressable market in the trillions. The narrative is intoxicating. They feel a pang of anxiety, a feeling of being left behind. They think, if I had just bought it 6 months ago, I'd be rich. So they do what they think is due diligence. They pull up the analyst reports, and what do they find? They find forecasts that simply take the explosive growth of the recent past and draw a straight line into the future. They find price targets that are even higher than the already inflated stock price. Their recency bias is confirmed by the experts. The narrative is validated by the numbers. It feels like a sure thing. So they buy. They jump on the bandwagon at the very moment it is most crowded, most celebrated, and most dangerous. They buy at the point of maximum optimism, just as the forces of mean reversion are gathering like storm clouds on the horizon. And when the growth inevitably slows, when the narrative cracks, the stock plummets. They are left holding the bag, having bought at the top and selling in a panic at the bottom, swearing off the stock market as a rigged game. It wasn't rigged. They were simply playing the game with a fatally flawed mental model, mistaking a trend for a destiny. The direct financial consequence of this mistake is a phenomenon known as the growth trap. This is a crucial concept for anyone serious about portfolio growth. The trap is this. You can be 100% correct about a company being a fantastic high-growth business and still end up with a terrible investment return if you pay too much for that growth. The price you pay is the ultimate arbiter of your future returns. Let's make this tangible. Imagine two companies. Company A is a technology darling. Everyone agrees it's a phenomenal business, and it's expected to grow its earnings by a rapid 15% per year for the next decade. Because of this excitement, its stock trades at a very high valuation of 50 times its annual earnings. Company B is a boring, established consumer goods company. It's a good business, but it's only expected to grow its earnings by a modest 5% per year. As a result, its stock trades at a much more reasonable valuation of 15 times earnings. The typical hot stock chaser would pile into Company A and ignore Company B. But let's run the numbers. Let's say you invest $10,000 in each. Over the next 10 years, Company A's earnings do, in fact, grow by 15% annually, a huge success for the business. But because growth eventually slows for every company, the market decides that a 50 times earnings multiple is no longer justified. The valuation multiple reverts toward the mean, and in 10 years, it trades at a more normal 20 times earnings. Company B's earnings grow by a slow and steady 5% annually. Because it was already priced reasonably, its valuation multiple stays at 15 times earnings. When you calculate the final value of your investment, a surprising result emerges. The investor in the boring, slow-growing Company B often ends up with a significantly higher total return. Why? Because while Company A's earnings were growing rapidly, its valuation was shrinking. The headwind from the collapsing P/E ratio offset much of the benefit from the earnings growth. The investor in Company B, on the other hand, enjoyed the modest earnings growth without any headwind from valuation. They paid a fair price and got a fair return. The investor in Company A paid a spectacular price for a spectacular forecast, and, even though the company delivered, their personal investment result was mediocre or even negative. This is the growth trap. It is the mathematical proof of the danger of extrapolating growth and ignoring valuation. It's a mistake that stems directly from believing the beautiful straight-line forecasts and forgetting the powerful gravitational pull of mean reversion. Having now dismantled the two core pillars of the forecasting illusion, the pretense of precision and the fallacy of extrapolation, we must turn from what not to do to what we must do instead. If we are to ignore the siren song of the spreadsheets, where should we focus our attention? The answer lies at the very heart of the Buffett-Munger philosophy. It is the third and perhaps most important pillar of our journey, building a qualitative fortress by focusing on the business's economic moat. A moat is a durable, sustainable competitive advantage that protects a business from invaders, just as a moat filled with water protects a castle. It is the qualitative feature that allows a company to earn high returns on capital for a very long period. It is something that cannot be captured in a single cell on a spreadsheet, yet it is the single most important determinant of long-term business value. The perfect story to illustrate the power of a qualitative moat over quantitative forecasts is Buffett's 1972 acquisition of See's Candies. On paper, See's was not an obviously compelling investment. It was a mature, family-owned box chocolate company based in California. Its growth prospects were modest. If you had run a standard financial model based on its historical growth rate, it would have produced a lukewarm valuation at best. The business had physical assets, kitchens, stores, inventory, worth about $8 million. The owners, the See family, were asking for $30 million. Buffett's own partner, Charlie Munger, initially balked at the price, which was more than 3 times its tangible book value. From a purely quantitative perspective, it looked expensive. But Buffett saw something that the numbers didn't fully capture. He saw an economic castle surrounded by a deep and enduring moat. That moat was the See's Candies brand, lodged deep in the minds of its customers. For decades, when a person in California needed a gift for Valentine's Day, Mother's Day, or a birthday, their mind didn't go to a box of chocolates, it went to a box of See's. The product was associated with quality, nostalgia, and affection. This powerful psychological association gave See's something that most businesses can only dream of: pricing power. Buffett realized that See's could raise its prices by 10% every year, and customers would barely notice. They weren't just buying chocolate, they were buying a trusted solution to a social problem. They would not risk disappointing their mother or their sweetheart by switching to a cheaper, unknown brand, just to save a couple of dollars. Buffett and Munger ultimately paid $25 million for the company. That initial investment proved to be one of the best in financial history. Over the years, See's has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, cash that was then reinvested into other wonderful businesses. The beauty of the See's model was that it required very little additional capital to grow. The annual price increases fell almost entirely to the bottom line. This gusher of cash, produced by a business with a qualitative moat, became a critical funding engine for the entire Berkshire empire. Had Buffett been a slave to a financial model, he would have missed it. He would have seen a slow-growing company trading at a premium to its assets. But because he was a business analyst focused on the qualitative strength of the moat, he saw a cash generation machine of incredible power and durability. He saw the castle, not just the balance sheet. Why is it that so many investors, particularly those with a quantitative or financial background, so often miss these powerful qualitative factors? The underlying psychological principle is what we can call the intangible value blind spot, a variation of the old saying, "What gets measured gets managed." In the world of finance and business analysis, there is a massive bias towards things that can be easily quantified. Earnings per share, debt-to-equity ratios, growth rates, cash flow. These are the building blocks of financial models and the language of Wall Street. They are concrete, measurable, and fit neatly into a spreadsheet. Intangible assets like brand loyalty, a unique corporate culture, or the network effects of a platform are messy. You can't assign a precise number to the value of the Coca-Cola brand in the mind of a consumer. You can't easily model the high switching costs that keep a business locked into using Microsoft software. Because these things are hard to measure, they are systematically undervalued by a financial system obsessed with quantification. This is a classic case of looking for your keys where the light is shining, not where you actually dropped them. The light of Wall Street shines brightest on the quarterly earnings report, so that is where everyone looks. Buffett's genius has been his willingness to spend his time in the shadows. analyzing the fuzzy, unquantifiable, but ultimately more important factors that determine long-term success. He understands that a business with a powerful but unquantifiable moat is far more valuable than a business with mediocre economics that can be modeled with pinpoint precision. He prefers the vaguely right to the precisely wrong. This blind spot in the market is what creates the opportunities for those who are willing to do the hard work of qualitative business analysis. So how do we, as individual investors, learn to spot these moats? We need a practical blueprint, a systematic way to identify and classify durable competitive advantages. The most effective framework for this was popularized by portfolio manager Pat Dorsey, who breaks down economic moats into 4 primary categories. This 4 moats checklist is the applied mental model that can transform your investment process from number crunching to true business analysis. The first type of moat is intangible assets. This includes things like brands, patents, and regulatory licenses. The key question to ask is, does this intangible asset allow the company to charge a premium price for its product or service compared to a generic equivalent? The See's Candies brand is a perfect example. Tiffany & Company is another. They sell jewelry for many times the price of its commodity metal and stone content because of the power of the little blue box. Pharmaceutical companies with patent protection on a blockbuster drug have a powerful, albeit temporary, moat that allows them to charge very high prices. A television station with a government-granted broadcasting license has a local moat that is very difficult for a competitor to breach. The second type of moat is switching costs. This is a powerful advantage that exists when it is a significant pain or expense for a customer to stop using a company's product and switch to a competitor. Think about your local bank. Moving your checking account with all its automatic payments and direct deposits is a massive hassle, so you stay, even if another bank offers a slightly better interest rate. The same is true for enterprise software companies like Oracle or SAP. Once a large corporation has built its entire operations around their software, the cost and risk of switching to a new system is astronomical. Apple has built an incredibly powerful moat through the switching costs of its ecosystem. Once you have an iPhone, an Apple Watch, and a MacBook, all seamlessly synced through iCloud, the thought of switching to an Android or Windows device is daunting. You would lose your apps, your data, your muscle memory. This creates incredible customer loyalty and pricing power. The third type of moat is the network effect. This is a unique and powerful advantage that occurs when a product or service becomes more valuable to each user as more people use it. The classic examples are credit cards like Visa and MasterCard. The more merchants that accept Visa, the more useful it is for cardholders. And the more cardholders that carry Visa, the more essential it is for merchants to accept it. It's a virtuous cycle that creates an almost impenetrable duopoly. Social media platforms like Facebook and professional networks like LinkedIn benefit from the same dynamic. Your Facebook account is valuable because that's where your friends and family are. A new social network, even with better features, is useless if no one you know is on it. The network effect creates a winner-take-all or winner-take-most dynamic that is incredibly difficult for competitors to overcome. The fourth and final type of moat is a cost advantage. This exists when a company can produce and deliver its product or service at a consistently lower cost than its rivals. This advantage can come from several sources. It can come from scale, like Walmart, whose massive purchasing volume allows it to demand lower prices from suppliers than any smaller competitor could hope for. It can come from a unique process, like the Toyota production system, which for decades gave the automaker a significant advantage in manufacturing efficiency. It can come from a unique location, like a gravel quarry located just outside a major city, which has a massive transportation cost advantage over a quarry 100 miles away. Geico, a longtime Berkshire holding, has a structural cost advantage over traditional insurers because its direct-to-consumer model bypasses the expensive agent network. These cost advantages allow a company to either undercut competitors on price or to earn higher profit margins. By systematically running a potential investment through this 4 moats checklist, you force yourself to think like a business owner, not a stock picker. You start asking the right questions. Is this business protected? Why? How durable is that protection? This qualitative analysis is the true foundation of any intelligent investment strategy. The financial numbers are simply the output of the business model. The moat is the engine that produces those numbers. Focusing on the engine, not the exhaust, is the key to long-term success. The antithesis to this moat-focused approach is what we can call the commodity business trap. The investor who falls into this trap is typically obsessed with superficial valuation metrics. They will screen for stocks with low price-to-earnings or price-to-book ratios, assuming that cheap is the same as good value. They might look at 2 airline companies. They see that Airline A trades at 8 times earnings and Airline B trades at 10 times earnings. They conclude that Airline A is the better buy because it's statistically cheaper. What they fail to recognize is that the entire airline industry is a brutal, capital-intensive commodity business largely devoid of moats. The service is nearly identical from one carrier to another. Customers buy almost exclusively on price. There are no switching costs. There are no network effects. There is no significant cost advantage, as fuel and labor costs are similar for all major players. As a result, the industry is characterized by vicious price wars, cyclical bankruptcies, and chronically low returns on capital. Buffett himself famously quipped, "If a capitalist had been present at Kitty Hawk back in the early 1900s, he should have shot Orville Wright. He would have saved his descendants a lot of money." The investor who buys the cheaper airline isn't buying a bargain, they are just buying a stake in a terrible business. Their portfolio becomes a collection of these low-quality, cyclical commodity producers. When the economy is booming, these stocks might do well. But at the first sign of a recession or an industry downturn, their profits evaporate, and their stock prices get crushed. They lack the defensive characteristics of a business with a real moat. They are fragile. The moat-focused investor, on the other hand, is building a portfolio of resilient businesses, castles that can withstand the inevitable economic storms. They may pay a slightly higher valuation for this quality, but they are buying durability and predictability that the cheap stock investor can only dream of. The financial power of a moat is not just a theoretical concept. It manifests directly and clearly in a company's financial statements, but you have to know where to look. A moat is a qualitative cause that has a quantitative effect. The 2 most important indicators are gross margins and return on invested capital, ROIC. A company with a strong moat, particularly one based on an intangible asset or high switching costs, will consistently exhibit high and stable gross margins. This is because they have pricing power. They are not forced to compete solely on price. Compare the gross margins of a company like Moody's, the credit rating agency with a powerful regulatory moat, to those of a generic manufacturing company. Moody's consistently posts gross margins in the 70 to 80% range, an astronomical figure. This reflects their ability to charge high prices for a service that their customers must have. The commodity manufacturer, on the other hand, will have thin and volatile gross margins as they are constantly squeezed by customers and competitors. Return on invested capital is an even more powerful metric. It measures how efficiently a company is using its capital, both debt and equity, to generate profits. A truly wonderful business can generate high returns on the capital it employs. A business in a competitive, moatless industry will struggle to earn returns that are better than its cost of capital. Great, moated businesses are capital light. See's Candies was a perfect example. It generated massive profits without requiring massive reinvestment. Companies with strong network effects, like Visa or Google, are also incredibly capital light. Once the network is built, each new user adds revenue at a very low incremental cost, leading to fantastically high ROIC. When you analyze a company's financial history, look for a long track record of consistently high and stable ROIC, preferably above 15% without the use of excessive debt. This is the financial fingerprint of a high-quality business. It is the numerical proof that a qualitative fortress exists. It's where the story of the moat meets the reality of the balance sheet, providing the concrete evidence needed for a sound investment decision. However, even a company with the widest moat in the world can be a terrible investment if it is run by the wrong people. A fortress needs a competent and trustworthy castellan to manage it. This brings us to our fourth pillar, the human factor. It is the principle of betting on the jockey, not just the horse. A great business is a wonderful starting point, but its potential can be squandered by dishonest, irrational, or empire-building management. Conversely, an exceptional manager can take a good business and elevate it to greatness. Therefore, a crucial part of our analysis, a part that is entirely ignored by financial forecasting models, is a rigorous assessment of the quality and character of a company's leadership. There is no better example of the kind of manager Warren Buffett loves to bet on than Tom Murphy, the former CEO of Capital Cities/ABC. Buffett has repeatedly called Murphy the best business manager I've ever met. The story of Capital Cities is a masterclass in rational management and intelligent capital allocation. Murphy and his partner Dan Burke started with a single floundering UHF television station in Albany, New York in 1954. Over the next 4 decades, they built a media empire that included television and radio stations, newspapers, and the entire ABC network. They did it not through visionary pronouncements or charismatic leadership, but through a relentless focus on the fundamentals of business. Their management style was legendary. They ran a highly decentralized organization, giving local managers extreme autonomy, but holding them strictly accountable for their financial results. They were fanatical about cost control, famously scrutinizing every line item on a budget, but their true genius lay in their skill as capital allocators. They were masters of the acquisition. They would buy undermanaged media properties, ruthlessly cut unnecessary costs, improve operations, and use the gushing cash flows to buy their next property. They were patient, disciplined, and would only act when the price was right. The culmination of their career was the 1985 acquisition of the ABC television network. At the time, Capital Cities was a far smaller company than ABC. It was a minnow swallowing a whale. To finance the $3.5 billion deal, Murphy turned to Buffett. Buffett's Berkshire Hathaway provided $517 million in financing, a massive sum for Berkshire at the time. When asked why he made such a huge bet, Buffett made it clear. He wasn't just investing in the assets of ABC, he was investing in Tom Murphy and Dan Burke. He knew that their rational, shareholder-focused management style would unlock immense value from the somewhat bloated and bureaucratic network. He was right. Murphy and Burke transformed ABC, and Berkshire's investment was a home run. The story illustrates a core Buffett tenet. When you find a brilliant manager with a long track record of integrity and operational excellence, you bet on them heavily. The human factor can be just as important as the economic moat. The necessity of judging management stems from a fundamental conflict in corporate governance, known as the agent problem. In a public company, the shareholders are the owners, the principals, and the management team, led by the CEO, are the employees hired to run the company on their behalf, the agents. In theory, the agents should always act in the best interests of the principals. In reality, their interests often diverge. A CEO might be motivated by a desire to build a larger empire, even if it means making overpriced acquisitions that destroy shareholder value. They might desire a lavish headquarters, a corporate jet, and an astronomical salary, all of which come at the expense of the owners. This is the central conflict. Compounding this problem is our psychological tendency to fall for social proof. We are wired to trust people who appear successful and confident. A charismatic CEO who graces the cover of business magazines, gives eloquent interviews, and paints a grand vision for the future can be incredibly persuasive. We see other people admiring them, and we assume they must be brilliant. This is the celebrity CEO phenomenon. We get swept up in their personality and their story, and we stop critically evaluating their actions. Buffett consciously resists this. He is famously skeptical of the slick, promotional CEO. He prefers the quiet, rational operator who is obsessed with the details of the business and communicates with shareholders in plain, honest language. He looks for a manager who truly thinks like an owner, not like a hired hand. To avoid the principal agent trap and the allure of the celebrity CEO, we need a practical blueprint for evaluating management. This management litmus test can be constructed directly from the principles laid out in Buffett's decades of shareholder letters. It's a checklist for judging a manager's character and competence. First, you must read the last 10 years of the company's annual reports, paying special attention to the CEO's letter to shareholders. The key thing to look for is candor. Does the CEO openly and honestly discuss the company's mistakes and challenges? Or is every letter a puff piece filled with corporate jargon and relentless optimism, where every failure is spun as a learning experience? A manager who is not afraid to admit error is a manager who is likely to be rational and trustworthy. As Buffett says, it's the managers who promise to talk straight to you in the annual report, and then did so, who have the sterling qualities that we look for. Second, analyze how they talk about profits and performance. Do they crow about record total earnings even when the number of shares outstanding has increased dramatically? Or do they focus on what truly matters to owners, the growth in earnings per share? A great manager understands that issuing new shares to make an acquisition or fund operations is a real cost to the existing owners. A promotional manager will ignore this dilution. Look for a deep understanding that the goal is to increase the intrinsic value of each individual share, not just the overall size of the company. Third, and most critically, examine their track record of capital allocation. What has management done with the company's free cash flow over the past decade? This is the ultimate test of a manager's skill. Have they reinvested it in high-return projects within their circle of competence? Have they made smart, disciplined acquisitions at reasonable prices? Or have they engaged in diversification, buying unrelated businesses they don't understand, often at the peak of the market? Have they bought back the company's stock? And if so, did they do it intelligently when the stock was trading below its intrinsic value? Or did they buy it back at inflated prices just to prop up the stock price? A CEO's most important job is deploying capital. Their track record on this front is the clearest window into their business acumen. Fourth, dig into the proxy statement and look at the executive compensation plan. Is it sensible and aligned with the long-term interests of shareholders? Or is it designed to lavish rewards on management for hitting short-term, easily manipulated targets? Look for compensation plans that reward long-term growth in per-share value or return on invested capital. Be wary of plans that rely heavily on stock options granted at low prices, which can reward managers for mediocrity in a rising market, or those that have massive bonuses tied to hitting a quarterly earnings number, which can encourage short-sighted and value-destructive behavior. The opposite path, taken by the 99%, is to fall for the celebrity CEO cult. This is the investor whose entire thesis is based on their admiration for a charismatic leader. They buy Tesla because they are a fan of Elon Musk. They bought WeWork because they were mesmerized by Adam Neumann's vision. They hang on every tweet, every interview, and treat the CEO's pronouncements as infallible prophecies. This emotional attachment makes them blind to glaring red flags. They will ignore insane levels of stock-based compensation that massively dilute their ownership. They will overlook a history of value-destroying acquisitions or a pattern of over-promising and under-delivering. They will forgive a balance sheet loaded with debt because they believe in the leader's genius to overcome all obstacles. This cult of personality is incredibly dangerous. It substitutes faith for analysis. When the inevitable problems arise, these investors are the last to see them. Their identity becomes intertwined with the CEO's success, and they engage in motivated reasoning to dismiss any negative information. And when the charismatic leader finally stumbles, the entire investment thesis collapses, because it was never based on the underlying business fundamentals in the first place. It was built on the shaky foundation of a single personality. The quality of management is not just a soft, fuzzy concept. Its impact is directly visible on a company's financial statements. A great capital allocator who intelligently buys back stock will leave a clear trail. You can look at the shares outstanding line on the balance sheet or income statement. In a company run by a shareholder-focused manager, this number will tend to trend downwards over time. Each share you own becomes a slightly larger piece of the business pie. In a company run by an empire builder, the shares outstanding will constantly increase as they issue new stock to fund ever larger, often ill-advised acquisitions. Your slice of the pie is constantly getting smaller. Similarly, a manager's skill shows up in the return on equity, ROE. A great manager will generate a consistently high ROE without using a lot of leverage or debt. They are efficiently using the owner's capital to generate profits. A mediocre manager might be able to post a high ROE by piling on debt, a risky strategy that can be fatal in a downturn. By analyzing the long-term trend in shares outstanding and the quality of the company's ROE, you can find the hard, financial evidence that separates the truly great operators from the slick promoters. This quantitative data validates the qualitative judgment you've made about the human factor at the helm. We have now established 3 pillars of a sound investment philosophy that replaces the fiction of forecasting. We must reject the illusion of precision, we must build our analysis around a company's qualitative moat, and we must rigorously evaluate the integrity and skill of its management. But there is one final crucial piece to this puzzle. It is the ultimate defense against the one thing we know for certain, that our own analysis will sometimes be wrong. The future is unknowable, and even the most careful study of moats and managers can be undone by an unexpected turn of events. This is why we need the 5th and final pillar, the margin of safety. This is the bedrock principle of value investing, the concept that separates investing from speculation. It is the bridge between analysis and action and the ultimate form of risk management. The principle of margin of safety is best illustrated by one of Buffett's earliest and most brilliant investments, the American Express salad oil scandal of 1963. American Express at the time was primarily known for its travelers' checks and credit card businesses, but it also had a less-known division that handled field warehousing. This division would certify the inventory held in a company's storage tanks, and that company could then use that certified inventory as collateral for loans. One of their biggest clients was the Allied Crude Vegetable Oil Company, run by a man named Tino DeAngelis. The problem was that DeAngelis was a fraud. His massive storage tanks in New Jersey, supposedly filled with valuable salad oil, were mostly filled with seawater, with only a thin layer of oil floating on top to fool the inspectors. When the fraud was discovered, Allied Crude Vegetable Oil went bankrupt, defaulting on over $175 million in loans from major Wall Street banks. The banks, holding worthless collateral certified by American Express, turned to Amex to make them whole. The market panicked. Wall Street assumed that the liability from the scandal would be so enormous that it would wipe out American Express entirely. Investors dumped the stock in a frenzy, and the price plummeted from over $60 a share to as low as $35. The forecast was dire: bankruptcy. This is where Warren Buffett, then a young, little-known money manager, saw an opportunity. Instead of panicking with the crowd, he did his own due diligence. He went to work like a detective. He went to restaurants and retail stores to see if consumers were still using their American Express cards and traveler's checks. He talked to merchants to see if they were still accepting them. He spoke with bankers and competitors. What he discovered was that the scandal, while a huge blow to the warehousing division, had done almost no damage to the core, incredibly profitable consumer-facing businesses. The American Express brand and its powerful franchise were intact. He then did a conservative calculation of the company's intrinsic value. He estimated what the core businesses were worth, and then subtracted the absolute worst-case potential loss from the salad oil scandal. Even with this pessimistic calculation, he concluded that the business was worth at least $60 per share, and the market was offering it to him for $35. This massive gap between price and conservative value was his margin of safety. He invested 40% of his partnership's capital, an enormous bet, into American Express stock. Over the next few years, the market's panic subsided. The company settled the claims for far less than feared, and the power of its core businesses reasserted itself. The stock price soared, and Buffett made a fortune for his investors. He didn't need a precise forecast of future earnings. He needed a conservative estimate of present value and a stock price that was ridiculously cheap in comparison. The margin of safety was his protection against the unknown. The psychological forces that create these opportunities are powerful. The primary driver is loss aversion, the well-documented finding from behavioral economics that the pain of a loss is about twice as potent as the pleasure of an equivalent gain. When a company is hit with bad news, like the salad oil scandal, and its stock price starts to fall, loss aversion kicks into overdrive among its existing shareholders. The emotional pain becomes intense, and their focus narrows to one thing, making the pain stop. This leads to what's called myopic risk aversion, where investors sell indiscriminately at any price, simply to get out. They are not making a rational calculation of value, they are fleeing a burning building. This emotional, fear-driven selling is what creates the bargain for the rational investor. The margin of safety is, in essence, the profitable exploitation of other people's panic. You are taking the other side of an emotional trade. While the crowd is fixated on the terrifying, but likely temporary, problem, you are calmly assessing the long-term value of the underlying business. The greater the fear in the market, the wider the margin of safety it is likely to offer you. Buffett's famous advice to, quote, be fearful when others are greedy, and greedy only when others are fearful, is a direct instruction to hunt for a margin of safety when loss aversion is running rampant in the market. How can we apply this powerful concept in a systematic way? We need a simple, practical blueprint. Let's call it the 2/3 rule. This is a way to make the abstract idea of a margin of safety concrete and actionable. Step 1 is to arrive at a conservative estimate of a business's intrinsic value. Crucially, this should not be based on a detailed, multi-year forecast. It should be based on simple, robust metrics. For example, you could take the company's average owner earnings, a Buffett metric similar to free cash flow, over the last 3 to 5 years to smooth out any anomalies. Then, apply a conservative multiple to that number. For a high-quality, stable, growing business, you might use a multiple of 15. For a more cyclical or average-quality business, you might use a multiple of 10. The goal is not to find the perfect value down to the penny. The goal is to arrive at a reasonable, conservative estimate that you have a high degree of confidence in. Let's say you do this analysis for a company and arrive at a conservative intrinsic value of $100 per share. Step 2 is to apply the discount. The 2/3 rule is straightforward. You do not even consider purchasing the stock until its market price has fallen to 2/3, roughly 66%, of your conservative estimate of its value. In our example, you would place the stock on your watch list and not even think about buying it unless the price fell to $66 per share or below. That 34% discount is your margin of safety. It is your shock absorber. It is the buffer that protects you when things go wrong. Perhaps a mild recession hits, and the company's earnings come in lower than you expected. Perhaps a new competitor emerges and erodes their profit margins slightly. Because you bought with a massive margin of safety, these minor setbacks will not lead to a permanent loss of your capital. The initial discount provides the cushion needed to absorb the inevitable surprises the future will bring. It is the most robust form of risk management there is. Let's examine the antithesis, the flawed approach that leaves most investors exposed. Many investors follow a strategy that sounds reasonable on the surface: growth at a reasonable price, or GARP. Others simply say they are willing to pay a fair price for a wonderful company. The problem lies in their definition of reasonable or fair. All too often, their assessment of a fair price is derived from the very same optimistic straight-line Wall Street forecasts that we have already proven to be fiction. They end up paying 100 cents on the dollar for a business, but their valuation is based on a perfect rosy future scenario. They are, in effect, walking a tightrope with no safety net. Their investment will only succeed if everything goes exactly as predicted in the beautiful spreadsheet. But the real world is messy. A company might face an unexpected lawsuit, a product launch could be delayed, a key executive could leave. When any of these minor, everyday business problems occur, the optimistic forecast is broken. The fair value that was predicated on that perfect future evaporates. And because they paid a full price with no margin of safety, their investment is immediately underwater. They have no buffer, no cushion to absorb the shock. Paying a fair price based on a perfect forecast is one of the most reliable ways to achieve mediocre or negative returns over the long run. The ultimate financial consequence of ignoring the margin of safety is the permanent loss of capital. This is the cardinal sin in Buffett's rulebook, which famously has only 2 rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. It's critical to understand the difference between price volatility and permanent loss. If you buy a great business with a wide moat and excellent management at a price that provides a large margin of safety, the stock price may still go down in the short term due to market fluctuations. This is price volatility. It is temporary and not a cause for concern for the long-term business owner. Permanent loss of capital, however, is what happens when you get 2 things wrong at once. You misjudge the long-term economics of the business, and you overpaid for it. If you buy a business whose moat is deteriorating, like Dexter Shoe, and you pay a high price based on a faulty forecast of its future, you will never get your money back. The intrinsic value of the business itself is declining. Even if the stock market recovers, your stock will not, because the underlying business is fundamentally broken. This is how wealth is truly destroyed. The margin of safety is your primary defense against this catastrophic outcome. It protects you from your own errors of analysis. Even if your assessment of the business mode or management isn't perfect, the cheap price you paid can bail you out. It is the ultimate acknowledgement of human fallibility applied to the practice of investing. It is the final and most powerful promise of a reality-based approach to the market. You have just spent this time re-engineering the very foundation of your investment mind. You have learned to see the ghost in the machine of Wall Street, the seductive but false promise of precision, and to cast it out. You now possess a powerful mental toolkit, a new operating system for making financial decisions that is no longer reliant on the flimsy fiction of forecasts. You have replaced it with a robust, reality-based framework built on the unshakable pillars of qualitative analysis, the durable competitive moat, the integrity of management, and the ultimate defense of a margin of safety. You have made the pivotal transition from a speculator, betting on numbers on a screen, to an investor, analyzing and valuing real businesses. This is a profound and permanent upgrade to your financial capabilities. But what we have constructed here is the ultimate defense. This is the fortress that protects your capital from the catastrophic errors that wipe out the majority of market participants. It is the system for achieving rule number 1, never lose money. But a complete investment philosophy must do more than just protect. It must also compound. It must have a powerful offense to complement its impregnable defense. Knowing how to avoid the bad ideas is half the battle, but how do you identify and act upon the truly extraordinary opportunities? How does the cautious, defensive mindset we've just built connect with the kind of bold, decisive action Buffett takes when he finds one of his famous fat pitches and invests billions in a single idea? This defensive shield is one side of the coin, but the razor-sharp spear of concentrated, opportunistic investing is the other. The video that is now appearing on your screen is the missing link. It is the bridge from defense to offense, from capital preservation to aggressive capital compounding. It addresses the critical question of what to do after you've built the fortress. It is the next piece of the map, revealing the offensive strategies that turn this robust risk management into a true wealth generation machine. Average investors spend their lives trying not to lose. The truly great ones have a system for winning big. You have mastered the art of the shield. The video on your screen will hand you the sword. The choice to complete your mental arsenal, to continue your ascent from a cautious investor to a formidable one, is yours. Click and let the transformation continue.